I've owned Disney stock for several years, and while I'm happy with the overall annualized rate of return that I've received, I'd also be happy to sell the stock at the right price. And so recently, I've written a covered call to capture a little bit more premium while I wait for Disney to hit the target price that I set when I bought the stock. Incidentally, if you'd like to know why I purchased Disney in the first place, you can check out a previous video I made called Disney Stock is Magical. Now, as far as the covered call that I just sold, I received a premium of $2.35, and that price included all the transaction fees, so that's the full-in premium that I received, $2.35 per share. The call has a strike price of $120, which is near my original targeted sale price, and the expiration date is June 21st of this year. So what was my rationale on developing this option strategy? Well, first off, let's look at that premium. $2.35 based on the current price of Disney gives me a return of 2%. And if you factor in my actual cost basis of what I purchased Disney for, the rate of return would be even higher. So to put that into perspective, over this 4-month period that I'm locked into the call, that 2% yield becomes annualized into a 6% rate of return, and that's a far higher yield than I'm going to receive parking my money in a standard money market fund. And so I view that as an above average rate of return. Now, as far as the strike price, it's near the targeted sale price that I set as a goal when I first purchased Disney stock. You can see from this chart over the last 5 years, Disney has approached and exceeded that $120 level, and the price has failed at that point. Now, ultimately, I do believe that Disney will break out and exceed $120 a share, but there's a lot of resistance above that level, and right now, I don't see it as acceptable risk for me to take. So my expectations over the next 4 months are to hold on to Disney stock. If it doesn't hit $120, I'll keep the 2% premium for selling the call. If it does get up to $120, I'll still be able to keep the 2% premium, and I'll gain the 5.6% of price appreciation. And by collecting this extra premium, it'll bring my total overall annualized return to almost 9%. Now, I don't consider that a home run rate of return, but anytime I can hold a good quality dividend paying stock like Disney and receive a rate of return anywhere near 10%, well, I consider that a solid base hit and a rate of return that I'd take all day long. So in summary, when would you sell a covered call? Well, number one, it's when you already own a quality, preferably dividend-paying stock that's worth holding over the long term. The second point to consider is whenever the annualized premium is greater than other alternatives that you have, well, that's usually a good indication that you're being adequately compensated for selling the call. And then finally, if the strike price is anywhere near the target sell price that you'd previously established, then it probably makes sense for you to think about selling a covered call. Well, hey, how will this all work out? We'll check back between now and June 21st, and I'll update you either when the position is exercised or when it expires. Until then, as always, this is John Pugliano wishing you the very best returns.